Welcome back. Listen, a lot going on. The markets, rates, war, write-downs from Europe, etc. What are the one or two key things that you are watching for the most today?
It's really management's worry about runaway inflation and also geopolitical risk. And that really sets up the conversation related to the consumer for loans, what CEOs think about raising money either for M&A or investment, and then ultimately if we're getting a shift back to a higher credit risk exposure. All three of these are being affected, as you've said, Brian, because of the macro backdrop.
Yeah, and you heard Jamie Dimon's comments. I mean, the numbers for J.P. Morgan Chase, and correct me if you disagree, Ken, the numbers themselves seemed okay. Not great, but okay. Some write-downs regarding to Russia, whatever. But, of course, Jamie Dimon kind of scaring everybody with his comments. But he's more vocal than the CEOs of these other companies. So do you expect the numbers to be relatively good, but maybe some CEOs coming out and kind of putting up a warning flare?
We're just not firing on all cylinders as we did in 2021. Obviously, the most glaring is the capital markets, which are down, and no management is going to have confidence about what the calendar is going to look like for deals, even for the second quarter. But the consumer is the one, because we're kind of like, instead of batting 4 for 4, we're 2 for 4, with the strength coming in credit card spending and also personal loans. But the mortgage market and loan activity is down significantly. And so, as you know, Brian, auto loans are down because there just aren't any cars out there. So we're getting nicked here and there. And what that means is it's going to be hard to really have a strong print for performance for 2022.
Is investment banking going to be strong? Is trading going to be strong? I mean, how does this stock market reversal in the first 3 months of the year and higher rates can impact the numbers going forward?
Going forward, market volatility is going to benefit trading in fixed income, currency, and commodities. Those areas will do very well. Equity trading, so long as we don't go into a bear market, will also have strong trading volume. But again, equity underwriting, IPOs, and M&A, those are the really important fee-based areas that are likely to be not as strong as last year. Putting that to the side, then we get the bull case scenario, which is a rising rate, a steepening yield curve. I think it's important for managements as they'll calibrate well. If we go up 50 or 100 basis points in rates, it means X billions of dollars that they get in net interest income later this year. That's going to be the best thing we hear today.
You know, and sort of the common wisdom, which, by the way, I'm always nervous about when everybody says, well, as rates go up, bank stocks go up. We're finding now, Ken, that even as rates go up, it doesn't mean that big banks and their net interest margins are necessarily going to soar. Why aren't higher rates making the banks boom right now?
Yeah, and J.P. Morgan on net interest spreads were puny. And I think the real concern is, yeah, we get 7 or 8 rate increases from the Fed with a couple coming up early at 50 basis points. That's going to help. But when you look at the overall picture, and it gets back to my point about the consumer, when we move from quantitative easing to quantitative tightening of the Fed's balance sheet, does that stall or hurt the economy well before you can make money on rising rates for the banks? To me, that is the premier story for 2022.